Last week, we covered TD Bank's most recent quarter with unadjusted earnings that equity analyst Michael Miller describes as messy. But these developments didn't have us lowering our fair value estimate for the bank. After all, how much of a surprise is higher operating and credit costs in today's inflationary environment? And how shocked are we that we're seeing higher provisioning on loans that may underperform? We feel a similar way about the Bank of Montreal. After a weak first quarter, we're not changing our fair value estimate for BMO stock because we already projected higher credit costs in 2024. The credit business at BMO was particularly disappointing last quarter, according to Miller. However, investors who may be about to react to a 40% sequential increase in loan provisions should consider that most of these allowances are in loans that haven't gone bad yet. There are other important similarities with TD for investors to consider, such as BMO's exposure to Canadian real estate, which is one of the smallest of the big six Canadian banks and which we view as a manageable risk. There is also BMO's promising U.S. exposure with its acquisition of Bank of the West. Acquisitions have been a key source of growth for the bank, although we note that management has emphasized pursuing organic growth first. Perhaps BMO's focus on organic growth is because acquisitions like the recent addition of Bank of the West distort our growth projections, not to mention the expense side of the equation, which is muddy enough. There will be one-time charges during 2024, notes Miller, even as BMO commits to expense-saving efforts, so we don't expect to see the true expense base for the firm until 2025. On the upside, if investors are willing to wait a little longer, by 2026, we have this latest acquisition adding roughly 15 billion Canadian dollars pre-tax, and of course, before any provisions. For Morningstar, I'm Andrew Willis.